And I want to thank our guests here, Commissioners Gallagher and O'Malley, as well as Director Norton for joining us today. And our moderator today is Peter Schrader. Peter does great work on corporate governance issues for the Hill, and he's going to introduce our panel and guide our discussion. Please help me welcome Peter Schrader.
Thanks, everybody. We've got a great panel ahead of us, and I'd like to just kind of start with the Reader's Digest version of the people in front of us here. Immediately to my left here is Commissioner Gallagher from the SEC. He's been with the Regulators since 2011, and before that had actually put in a longer stint as a longtime staffer there, followed by a brief stint as a partner at WilmerHale. At the time, he's worked at the SEC as a staffer with Commissioner Paul Atkins under Chairman Christopher Cox, and has been as a commissioner since 2011. He's got his JD from Catholic University and a BA in English from Georgetown. Immediately to his next side is Commissioner Scott O'Malley from the CFTC. Been there since 2009 and previously was a staff director at the Senate Appropriations Subcommittee on Energy and Water Development. Also spent time on the staff of the Senate Energy and Natural Resources Committee under Senator Pete Domenici, and also was a senior legislative assistant to Senator Mitch McConnell, and he has his BA from the University of Michigan. And then all the way over there to the far left is Director Jeremiah Norton from the Fdic. Been there since 2012. Previously was Executive Director of JP Morgan Securities, and also spent time as the Deputy Assistant Secretary for Financial Institutions Policy at the Treasury Department. He also was a staffer to Congressman Ed Royce, still doing work on the House Financial Services Committee. And he has his JD from Georgetown and his economics degree from Duke University. That all being said, I'd like to get underway here. And I think it's sometimes productive with these sorts of discussions to start just kind of by laying out a baseline foundation here. And I'd be interested in hearing from you just kind of specifically, what do you view the purpose of financial markets to be? What's the goal here? What are we trying to accomplish? And what exactly is the role of regulation in that process? Commissioner Gallagher.
Well, first of all, thanks for having me here. I'm really happy to be here. Sounds like a great conference you've already had this morning, and I hope the rest of it is too. I think I'll give the standard disclaimer for the three of us that our views are going to be our own and won't represent our respective bodies, and at least with me, and I'm pretty sure with Scott, it becomes obvious pretty soon. So what's the role of financial markets? I think, from at the broadest level, to me, the financial market should be there to provide opportunity. At the SEC, we have a three-part mission. Everyone pays attention to investor protection as one of the pieces, but one of the other two is capital formation. And it sounds kind of vague in general, but it's incredibly important. The financial markets that we oversee are meant to provide a capital formation process for investors and for enterprise. And I think that the markets, to the extent they're allowed to, will provide that function. You will be able to find buyers and sellers of securities in the markets that we oversee. And the role of regulation when it comes to that process, to me, is to ensure that there's transparency, disclosure, and an understanding of risks in those markets. But it's not to be a merit regulation system. We're not to be administering a nanny state system of oversight. We're not supposed to be insuring investors against risk. And so I think the regulator has a very important job. At a top-line level, it is transparency, disclosure, and understanding. But beyond that, the markets tend to work pretty well when regulators understand and respect that role.
So in our markets, commodity markets, think about the early days when they were the egg and butter markets, where they started off hedging those risks on products that could obviously be spoiled, and you'd want to figure out how you hedge your risk in those markets. And they've evolved to include the $700 trillion global notional value of the swaps market today. So our primary market mission is to detect and prevent fraud, manipulation in the market. The fundamental use of our markets is price discovery and hedging. To Dan's point, our job is not to set prices. Frequently and obviously in 2007 and 8, when oil prices go over well over $100 a barrel to 147, people like us people consider us to be a price-setting agency and want to, see how we're going to push the price of oil down. That's not what we do, and sometimes we take a lot of grief for that. But that's not in our mission, and nor is it within our capability. So those are the primary missions that we're focused on, and it is about transparency. We can help investors. We can make sure that the markets are not subject or eligible to be manipulated and misused by participants. So we have to remain vigilant on that. We want to make sure that fraud is not part of our markets. That hurts investors and undermines the hedging and price discovery functions.
Well, I first want to echo Dan's thanks and disclaimers about statements being our own. And really, for me, it's a simple way about thinking about markets. You want to match investors and savers and allocate capital most efficiently. And then, obviously, our different agencies have roles in that. At the FDIC, we came about in the wake of the Great Depression, the bank runs. We're supposed to be a stabilizer of deposits. The U.S. government has provided a very large safety net to the financial system and to the banking industry in particular through deposit insurance. And I think it's a primary mission of the FDIC to help with that stability, but also make sure the safety net isn't being used in an inappropriate way and leaving the American citizen on the hook.
And it's interesting that you bring up that the FDIC came about primarily as a way to kind of tamp down public concern about where their money was going, basically. And we're here, we're coming up on 6 years since the financial crisis, but confidence in the markets remains an ongoing issue. Obviously, everybody was aware of what happened when Michael Lewis's book came out and the allegations there. It set up a whole fresh debate about, are markets fundamentally fair? Does a retail investor have a fair shake in the markets? And I'm curious, from your position as regulators, what do you do? We're years away from the crisis. What steps are there still to be taken to restore that confidence in the market that is still clearly in a weakened state? What are you supposed to be doing, and how critical is it to get people to buy into the idea that the markets are a fundamentally fair place for them?
Well, you want me to go first? We'll start in order, but I'm sure it'll devolve quickly. If it were me, and none of us, unfortunately, are in control of the agenda of our agencies. It's much to the chagrin of the American markets. If it were me, the thing that would be incumbent upon all of us as regulators to do would be to actually take a hard and serious look at the actual causes of the financial crisis. We say it 6 years ago, 5 years ago. It almost sounds quaint. There was a great journal editorial about amnesia with respect to financial crises. It was Alex Pollock put out. It was terrific last week. But the point that occurred to me is amnesia as to what, right? The narratives of the crisis that have been fed to us through the Dodd-Frank Act, through the FCIC report, which was a minority-majority report. I think we have to ask the serious question, have we actually gotten to the core causes of the financial crisis? And if we think we have we addressed them? And for me, at a top level, knowing that the words Fannie Mae and Freddie Mac are not within 2,319 pages of Dodd-Frank, it's impossible to believe we've actually gotten at the core causes. So then what are we doing? What do I do with half or more of my day? I come in and I chase false narratives with rulemakings mandated through Dodd-Frank that tell me to go after and resolve these things that caused the financial crisis. Well, it's one view of what the financial crisis was as codified in Dodd-Frank, and personally, as you can tell, I disagree with it. And until and unless we get at those core issues, I'm not sure how much confidence that investors will have.
Let me take a little different take on it, and I agree with Dan's point about the narrative and what some of the root causes are. So the CFTC has the responsibility under Title VII to implement all these rules, and we've been quite aggressive and accomplished quite a bit. We have 63 rules that we've completed over in the 4 years. We're coming up on the 4-year anniversary of signing a Dodd-Frank. So in that time, we've put forward 63 rules. Now it's really incumbent on us to go towards in addressing the customer issue and building confidence in our markets is to fix the rules we got wrong. And we've got some beauties.
Beauty's in the eye of the beholder,
Yeah,
I guess.
This is where I'm speaking for myself, I guess. So, I find that the swap dealer rule is, Congress said protect the end user. Well, we made it extraordinarily vague, broadly applied the swap dealer definition, and as a result, you had all the energy people trading energy markets move to the futures markets. Not because price discovery was any different, not because the price was any better. We set the margin at the same level for both markets. What we did do is create a whole new regulatory overlay called swap dealer definition and applied it to these guys. And they ran entirely in one day. October 12th, market effective swap dealer rules are applied. The next day they move, or the next weekend, the next Monday, they moved entirely to futures traded markets where you have regulatory certainty, you have clear rules around settlement and costs and transparency around the exchange trading. But they fled the regulatory overlay. And when you go back, you look at the Lincoln Dodd letter that said, hey, let us remind the letter to the regulators and to the House, we don't want to impact end users. Well, you just futurize the entire swaps market, in energy at least. And we're beginning to see this manifestation of all of these regulatory results as a result of regulatory arbitration. We've got rules in Europe that are completely different than rules in the U.S., and we're beginning to see trading and banks reorganize in different in jurisdictions to serve those clients. I mean, they are global markets and they're global banks, and they're serving these clients, but they have to do it outside the U.S. rules because no non-U.S. entity would ever trade with a U.S. person under the rules we have today. So, it's unfortunately 4 years later, we're not going to undo Dodd-Frank, but we really, as regulators ourselves, have to make the rules as transparent, useful, easy to use, and efficient. Not create new problems, but to fix the old problems. So we have our hands full on that front.
So you said you have 6 years. People, I think you maybe used the word, are frustrated or have distrust of what happened. And if you go back 6 years, the American people stood behind the financial system and provided a massive amount of support to investors, creditors, counterparties, and that support was not fairly distributed. And so I think until we get back to a place where distribution of resources is recognizable in a market function, that trust is going to continue to be there. So what's that mean? It can mean lots of things. I'd take Dan's point. We still have a huge support for Fannie and Freddie in the mortgage market. So we had a financial crisis, the government opened up its purse, and here we are still supporting Fannie and Freddie 6 years later. If you go around the country or the world and you say, what happened in 2007, 2008, what's one of the causes of the financial crisis? People might say, well, maybe mortgage. Okay, so the U.S. banking regulators looked at capital requirements for mortgages, and we didn't change them. So I think people are cynical for a reason. We're reforming areas that may not have contributed to the crisis, and we're leaving other areas untouched that really need reform. And so I guess, in summary, my answer is until we take that safety net, which is expanded considerably, and the Richmond Fed does very interesting work on this, until we take that back to some place that's more recognizable and have market functioning, I think there's going to be continued distrust.
And kind of along the similar lines, we're again, years after Dodd-Frank was enacted, most of the major pieces are in place, but we're still having a pretty contentious debate about too big to fail. There's a number of people on both sides of the aisle who still fundamentally believe this has not been dealt with. This is still an issue that regulators need to be taking a look at, or potentially Congress needs to be taking a look at. And kind of one of the responses that you hear from regulators when they're kind of pushed on this issue is that, I mean, one of the challenges is that it's hard to know if the tools in place would work until they're actually put to the test. And so I'm curious if there's anything, from your perspective, regulators can be doing on the too big to fail debate that can maybe elaborate a little bit on where we actually stand, given that we're still kind of dealing in these hypotheticals.
Well, to answer that and to build off what Jeremiah said, I think he nailed it. And I've said publicly before, the lingering confusion about the lender of last resort role of the Fed is driving bad policy across all of these regulatory agencies. There's the statements, too big to fail has ended. And then you hear speeches coming out of the Fed presidents, we need to expand the safety net in exchange for prudential regulation. Well, what is it? What has happened? What is the state of play with respect to lender of last resort? And if you boil it down, you think, well, geez, this is really causing bad policy and bad rulemaking, right? To the extent the FDIC and OCC and Fed have to consider increased capital margin outside of the banking sector, right? You hear about shadow banking and short-term financing markets. Well, is that with an eye towards making them more resilient generally? Or is it because we know at the end of the day, if 2008 happens again, we're going to backstop them again? And if it's the latter, why don't we just say so and build rules and transparency around that? And if it's not, then boy, we're in kind of a mess. Putting aside the proficiency I expect of the FDIC in running Title II.
Yeah.
Those of us who watched the Lehman bankruptcy proceeding and assume we'll be back in bankruptcy court think that maybe the Title 14 exercise would be a little more useful. So I just think that there is a stunning lack of clarity right now, despite pronouncements and despite what is purported to be within Dodd-Frank, about whether or not institutions can fail or not. And that's why I've been pretty loud on this issue for years. The SEC had, at least until Dodd-Frank, I hope still to this day, oversees markets, market participants, and products that can and should fail. And the emphasis should be on failure, not keeping them alive. It's the mortician role, not the ER doctor. And that is at odds with the bank regulatory paradigm of systemic risk and keeping institutions healthy to keep them away from the backstop. It makes sense that there is a complete divide between the two. But now there's been such a blurring, and Dodd-Frank has created such sweeping yet vague powers for many of these prudential regulators that I think from a policy perspective it's impossible to discern whether or not too big to fail has been dealt with. And if you had to bet right now, I would say it hasn't.
I would second that. I don't think, and you don't want to certainly have to test it, right, of course.
No, and look, I mean, and one of the problems is too, and this is a bipartisan affliction, is that lender of last resort, because of what happened in 2008, has been conflated with bailouts. Mm-hmm. They're totally different things. You have to be able to say, as a free market guy, I can say that lender of last resort is different than bailouts and should be different than bailouts. And if we're not going to have lender of last resort, query why we have the Fed, because I think that was one of the main reasons they created it. But we should say it and create policy around the fact that there will not be a lender of last resort. Sorry.
No, we've put in place various mitigating factors to, clearing, transparency around trading, et cetera. But at the end of the day, I don't think that we have solved the too big to fail.
I guess from my perspective, I look at the issue in two ways. One box for me is distance to default, and the other is resolvability. And so, a bit parochial, but from my perspective as a banking supervisor, distance to default, things like capital, liquidity, stress testing, how far are you moving away from that line? And I think it's very debatable how far we've moved. A lot of people like to talk about statistics, and sometimes they measure from like Q4 2008 and say things have gone up X percent, and that measuring at the low point, you'll get better progress. But how far have we moved from that line? And then there's the issue of resolvability. And I'm less sanguine than many other people in the regulatory community, notwithstanding my colleagues here, their comments about all the progress that's been made. We have a charge in Title I at the FDIC for resolution planning for living wills. And I think it's, at least in my mind, very debatable the agencies are handling that well. And then we have a Title II mandate at the FDIC, where lots of people talk about the single point of entry strategy that the FDIC staff has developed. But I like to remind people there's a difference between having an elegant strategy from having a workable solution. Yeah. And there are lots of things to discuss within that. But I'd just say I'm less sanguine that we've reached all the success that some people tout.
And you brought up the living will piece, so this is as good a time as any to talk about it. There seems to be kind of a lingering issue of whether or not people believe these living wills will work, whether or not these plans that banks are putting forward to the regulator are credible. And I was wondering if you could speak a little bit towards, what have you been seeing from the banks? How close are we to a point where we feel like the banks actually have a plan in place that could theoretically work if it were put to the test? And if we're not there, what do we need to do to get there?
So I'm going to just be careful. I'm not going to make any comment about any plan or any firm. I'd like to talk about the way the agencies are handling it. So we've been charged by the Congress to do something, and there apparently is some debate about what the statute says. There's not a lot of debate in my mind, and I actually think that achieving a state where bankruptcy works should be the goal, and we're not. I think we're not getting to the place at the agencies where the Title I is receiving the same amount of focus as Title II is receiving. So I'm concerned the conversation is almost skipping Part 1 of Dodd-Frank and going to Part 2. And that is a little bit familiar to me sitting at the Treasury in 2008, where people are looking to where they can access some support of the U.S. government in a process. And Title II has that. And there are all sorts of issues we can embed and uncover there, but we're at a point now where it concerns me people are trying to skip to Title II as the answer.
So is that just a recalibration of regulator focus at this point? What's the proper steps forward in your opinion?
I'm sorry, the proper
The proper step forward to get in a better alignment from your perspective.
There are lots of things in Dodd-Frank that I probably wouldn't have put in, but there is, I think, an importance of Title I in living wills that says, firms should be resolvable in a way that is orderly and doesn't impact the entire world. And if we could get to that state, you never want to declare victory, but gosh, you'd be in a lot better shape if that world is the world we live in.
And obviously, we're all here to talk about the 4 years since Dodd-Frank's enactment, and I'm curious to learn from each of you, having gone through the process, some of you for the entire duration, some of you for portions of it, what's been the biggest surprise to you going through this process? Obviously, this was, it's been repeatedly noted that this was the broadest financial regulatory, challenge for regulators in decades, since the Great Depression, perhaps. And I'm curious, what's your biggest surprise? What has been unexpected to you as you go through this process, and why exactly would that be a surprise? And is it a good thing or is it a bad thing that you were surprised by it?
Well, to build off actually the last comment, you don't think I can segue this, but I can. One of the surprises was that the SEC doesn't have access to the living wills of institutions that we regulate. So put that one in your hat and think about it. I think I can speak for you on that one too. The CFTC doesn't either. So.
Yeah, we've tied all of our contracts to that living will process and Title II resolution authority.
So that was a big surprise. Beyond that, I think at a more macro level, to me, I left. I was a co-acting head of the Division of Trading and Markets and was deputy director during the crisis, and left in January 2010, so about 6 months or so, 7 months before Dodd-Frank passed, and came back a year plus after Dodd-Frank was passed. So I thought I had a pretty good gauge on things. And the biggest shock to me was the amount of just unfettered distraction that was happening at the agency with respect to the death march of Dodd-Frank rulemakings, right? The silly notion that we could actually meet the congressional deadlines that were imposed, 1 year, 2 year deadlines. The fact that the SEC, if you use round numbers, if there were 400 rulemaking mandates in Dodd-Frank, the SEC got 100. Not bad for an agency that failed so miserably leading up to the crisis. Until you look at them and realize, oh yeah, this is our punishment for failing so miserably, purportedly, in the years leading up to the crisis. We're the ones tasked with never again allowing conflict minerals in the Congo to cause a financial crisis, right? We've taken care of that. So that won't happen again. You don't have to worry about that. Your kids and grandkids' 529 plans are fine. While at the same time, the bank regulators are actually doing more meaningful, more germane regulation and oversight pursuant to broader, more sweeping, and less understandable grants of authority in Dodd-Frank. So I think the amount of time consumed at the SEC, it's different, I think, for the CFTC, Scott, but on things that are entirely unrelated to the core mission of the agency and entirely unrelated to the financial crisis itself, I think is a shame. And I think citizens of this country, taxpayers, should be horrified that I came in and for the first 10 months of my commission spent 20% of my time on the conflict minerals disclosure rule. It's laudable humanitarian goals, not for the SEC, not in a financial crisis statute. And unfortunately, despite some recent glimmers of hope, we're still getting lots of pressure to finish the remaining 58 rules that lay in the Dodd-Frank mandates, and as opposed to focusing on the 75 plus years of federal legislation that preceded it, all of which amount to mandates to the agency to oversee the markets and market participants in our jurisdiction, we are still prioritizing critical things like the pay ratio disclosure over equity market structure review, over fixed income transparency. We want to talk about systemic risk, the fixed income markets right now because of the zero interest rate environment. And that's where we have a lot of authority. We're not able to exercise it because we're too busy following shiny objects.
I think it's kind of the eye-opening elements of this are in two areas. The first one is kind of the speed and the totality in which markets have moved to Europe in response to some of our trading mandates. The data shows that the mandatory trade requirements for US dollar products is trending upward. Credit default swaps are at 80%, 90% traded and cleared. US dollar at about 50%. But the numbers on the sterling and euro are falling significantly. That market is moving to Europe and is likely to stay there. So, and that's US persons and non-US persons trading that activity within the rules set in Europe. That is problematic. That is not something you can regulate back, right? You know, this is a harmonization effort. But kind of the response to our overreach and actually the response back from Europe has been not pleasant either. And that could contribute, if we don't resolve our differences quickly, further fracturing of liquidity. And we're just in denial that these are global markets and we shouldn't set up a global regulatory structure. The second part is kind of an internal challenge, and we developed all of these rules, massive amounts of requirements for swap dealer rules. We have over 200,000 pages submitted by the 110 swap dealers. We're not yet through all of those. We haven't, even though they've been kind of regulated for 2 years, we have not done the complete analysis on whether people are compliant or not. We had futurization, which I talked about earlier. And then in terms of market surveillance, we have, for 2 years, we've had swap data repositories, and all of this data flowing into the commission virtually useless to us right now because the quality is not there. The accuracy and our ability to aggregate across the different swap data repositories is not working. And so with poor data quality, inconsistent applications, and inability to aggregate, there's a moral hazard here that we've told everybody, hey, we've collected all this information, we've got all the data. I gave a speech a little over a year ago March, couldn't see the London whale. Still struggling probably to see the London whale. And to bring together what is a well-known entity, the cleared data, with the OTC data and develop that picture. We should be focusing on systemic risk. Isn't that why we're in this spot anyway? Identifying systemic risks, who has it, who blows up, who's going to contaminate the rest of the pool. Those are the kind of things that we should have been on. If you can picture, a kid out in the backyard throwing the football and also trying to catch it. That's what we do. We threw the bomb, and now we're racing to catch downfield to catch it. And so far, we are failing that.
It was a bomb.
And so we've got these massive regulatory mandates, yet our capacity to implement them ourselves is just not there.
Director Norton?
Yeah, I would maybe add on a couple of those themes. The rulemaking process, let's take just the U.S. and try to narrow that. I don't have any economic analysis behind what I'm about to say, but I do have a theory that if you
That's normal for the FDIC. That's fine.
if you take one agency on a rule and you add two, it's not linear in terms of making it more difficult. And then you add 3, 4, and 5, it looks like a hockey stick. It gets exponentially difficult to do anything. Some people might say that's good in some cases, but it's certainly not functioning. The other thing that I'd say is concerning me more and more, especially in the bank space, the global systemic risk space that I'm seeing, is the Financial Stability Board, which is a creature of the G20. That is more and more influencing, at least from my perspective, the policy that comes back to the U.S. agencies, at least in the banking space. And if you look at what that means, at least what I see is you have 20 European bodies on the FSB and 3 from the U.S. And we still have a dollarized financial system in the world. And as far as I know, the FSB is not a very public or transparent organization. I don't think there are minutes or votes or anything like that. But these rules come back, and the Europeans have 20 seats at the table, and we have 3. And so I wonder if that's the best way to create policy from the U.S. perspective. And
Do we have a seat at the table?
we don't.
They don't.
Oh, you don't.
We don't.
We don't
And that's not a
We do.
parochial.
It's a kids' table
I don't
off
mean
in
it
the corner.
parochially. You know, the FDIC doesn't, although the FSB is now charged by the G20 to fix too big to fail and have some sort of loss absorption, gone concern, loss absorption capacity mandate. The FDIC is not a member of the FSB, but we are the resolution agency. But what concerns me more is that Europe is having a lot of influence over U.S.-based rules.
Well, Jeremiah, isn't it interesting, too, that it's dominated by European interests? And in Europe, the markets, the financing markets, are 20% capital markets, 80% bank financing markets. And it's the exact opposite in the United States. So, and let's call the non-bank financing markets shadow banking for purposes of FSB. So they go off into their little cave in Basel and cook up lots of ideas for shadow banking that we're supposed to eat here domestically. The Europeans are having the last laugh on us, aren't they?
Well, I think what I've found in conversations, whether it's at the Treasury or now at the FDIC, people look out for their national interest, and I think we should too. So it doesn't surprise me that they would.
Boy, I think they just crack up at the end of every meeting.
And speaking of jurisdictional issues, I wanted to get your thoughts on the Financial Stability Oversight Council. That's kind of the broad overarching board that was meant to address the concern that regulators weren't talking with each other well enough. They weren't communicating well enough. Their information was getting siloed. So let's bring them all together on a regular basis and have them talk about what they're seeing broadly in the financial markets as systemic issues. The council has come under some criticism, particularly from Republicans, on issues like transparency, on the ability of people to work together, how exactly this whole kind of entity is functioning, who's calling the shots, how is this working out. And I want to get your thoughts on, now that it's been in operations for a couple of years, how is it working out? If there are problems, what are they, and what should be done to address them?
So I spoke about this first in February or March of 2012, and now, 2.5 years later, I can say, I told you so to everybody who's clamoring about the FSOC and its unfettered discretion, authority, and the opaqueness within which it operates. We have been uniquely impacted, I think, at the SEC. Is our chairman is a constituent member of the FSOC. The agency is not, and that was one of the things I talked about in early 2012 that at that time people hadn't even focused on. There was this notion, and there still is. If you saw the Treasury response letter that went to Jack Lew, went from Jack Lew to Congress a few months ago, and they talk about member agencies, and there is no such thing. There's a group of individuals that comprise FSOC, and for us at the SEC, it's our chairman. And kind of like FSB, to me, it's a similar yet domestic situation. They go off into their little cave and cook up stuff that the constituent member agencies, the agencies impacted by the individuals on the FSOC, are supposed to adopt. And For us, famously, of course, this came to a head in 2012 with respect to money market mutual funds. I was in the trenches, literally on the 30th floor of Lehman during the week of September 15th. To folks who were there and dealing with it, Jeremiah was over at Treasury. I mean, there was no doubt that you needed to do a little bit more than PWG, right? And the notion was to do a little bit more than PWG, standardize it, make it more formal. Information sharing was horrible during the crisis. Understanding of the data that the respective agencies had was deplorable. And something needed to be done. So I'm not one to say that the simple act of debating a systemic regulator, creating a council, doing something more formal is a bad thing. I actually think it's a good thing. But what we ended up with, like so many things in Washington, is a creature of compromise, and it simply doesn't work. It is opaque. There shouldn't be a situation when purportedly independent agencies are represented by a single individual on a council that commit to actions later to be taken by those agencies, and there's been no voice of the entire board or commission in that construct. And I'm a big fan of the commission structure and the board structure. It's good to have divergent views. I think it makes better policy, but you're not going to have that, and you haven't had that for the first several years of FSOC. You've had a clean slate of the president's hand-picked individuals driving really important policy at the most meaningful time of FSOC. Right, these first years where they create the rules for SIFI designations, when they actually do SIFI designations, when they create other rules, this is it. This is the formative stage of FSOC, and it's going to be really hard for anyone to unwind these decisions. And the fact that they're being made in the darkness, I find repugnant.
I echo that it suffers lack of transparency, participation that Dan accurately portrayed. We didn't need FSOC to tell us who the significant entities are in our markets. We know the clearinghouses are significant, and we're prepared to address those. We've got rules for those. So they're not really telling us anything we didn't know. I'm very sympathetic on this money market situation. It has not come to roost where the CFTC has done something and then overruled by a hand-picked club of partisans. But I think Dan's analysis is spot on. This could use a tune-up here and figure out how you're going to get more inclusive and respect the independent agency structure.
So is this a sort of arrangement where you'd like to see each of the commissioners have some sort of a voice at the FSOC? Would that address those concerns that you were elaborating on?
Well, the exact construct, I think, is open for debate. I think Chairman Garrett put forth a bill that would go a heck of a long way to fixing many of the flaws I see in FSOC. So, in lieu of any better idea, to me, that seems to be the leading candidate, to add transparency, to give a voice to the agencies who are implicated in this FSOC, as his bill would do, I think would be really important. Is there some ideal? To me, at the end of the day, just the focus on information sharing and data sharing and should have been first and foremost, as opposed to this ungodly authority to designate as systemically important certain institutions, which is just anti-American.
I'd like to build on that. I mean, the idea, the potential that we can improve our transparency and accountability and work with the other agencies is very important. The flash crash is a great example. It didn't take long before the SEC and the CFTC sat down and got to the bottom of this. We established an advisory committee. Ironically, no other commissioners save the chairman were permitted on that, and we should be included in those debates. But we did get into the discussion about how we're going to share and coordinate market structure issues to mitigate liquidity crisis like the flash crash 4 years ago. We're now working with OFR. We should have a protocol and a sense of how we're going to work and share it with one another. Ironically, despite the congressional achievements with FSOC, they also prohibited us from sharing proprietary data with our markets with anybody else. There is a blocking provision, an indemnification provision, that we can't directly share information with international colleagues to knit together the global risk picture, but also the OFR is prevented from providing any indemnification to our regulated entities on data. So we're having trouble sharing data there. So it is a fix in the House reauthorization bill. But we haven't seen the coordinating data analysis and information sharing out of FSOC. We've seen a variety of other things, but not the fundamental first order of business kind of things that would make our markets work so much better to have the transparency. Because believe me, everybody's trading our markets back and forth every single day at microseconds, and having some insight into that and having a coordinated, a legitimately coordinated, not a crisis by crisis coordinated surveillance system would be a lot more effective.
I mean, we haven't seen a focus on what the systemic risks are by FSOC, as far as I'm concerned. What we've seen is this march towards designations of specific entities and an all-consuming effort, right? Are they looking at the impact of interest rates and the creation of bubbles? You saw the BIS report came out a month ago, cautioning about central bankers creating new systemic risks, new bubbles in the markets. Why aren't we having our FSOC have those debates and try to stem those off and prick the building bubbles that we see? That's what it's all about. That's what people expected. That's the hard part of the job, identifying and pricking the bubbles. And instead, we're picking institutions who are now going to become too big to fail.
Oh, it's covered. Thanks.
Sorry, Joe.
I also I want to touch on the idea of when it comes time to write all these regulations in Dodd-Frank, the speed component of all of it. Between the SEC and the CFTC, we almost have this kind of study in contrast where the CFTC had a number of projects to pursue, and they pursued them fairly aggressively and got a lot of their regulatory work done quickly, met a lot of their deadlines, did that kind of an approach. And then the SEC has taken a little bit more of a deliberate approach, would be one way to describe it. They haven't hit all of the deadlines. There's been some pressure on the SEC saying they're not acting quickly enough. But at the same time, people wonder if the CFTC acted too quickly and if quality suffered as a result of that. And I wondered if you could speak a little bit about finding the balance between writing the rules that you're required to write and also meeting deadlines you're required to meet, and how you find the right balance between getting the rules right and getting them done quickly enough that they're done in the time frame that people actually wanted them to be done.
So I can speak for the SEC. We're a plotter, not a racer. And that's actually what I think people, to the extent you buy into the notion of independent agencies, that's what you should want, right? Technical experts spending lots of time trying to get things right. Otherwise, you would just have Congress do everything. I think that was the original idea in the New Deal. And when you then, though, because of the absolute onslaught of mandates, basically say, you, so-called independent agency, simply become a scrivener for Congress. Here's 7/8 of a mandate. Here's a little bit of discretion. Go get it done. It brings out the worst in the agency. Discretion is what it's all about. Understanding the markets, understanding the issues and the players, and doing a meaningful economic analysis so you can understand the consequences of what you're about to do takes a lot of time. As controversial as our money market fund rules are, putting everything else aside from a process standpoint, the proposal that came out last year, the final rule that will come out this year, agree or disagree with it, it's a typical SEC product of moving slowly and deliberately and taking into account all of these issues. And as I said, one of the biggest shocks to me when I came in as a commissioner was all that had gone out the window. It was, let's get this stuff done. And in a crazy drive to get 100 rulemakings done, which in a normal situation would take 20 years, right? And Congress said, let's get them done in 2. There was a rush, and Scott alluded to this earlier, to get proposals out the door. Rulemaking is 2-part, a proposal and then a final rulemaking. Well, you put garbage out, and you're going to get garbage in, and that's what we did. So we got a lot of garbage at the SEC right now, and a pending final rulemaking where we're trying to say, well, we realize we didn't do such a good job on this proposal. We realize the comments say it's just awful. Can we have a final rule, or shouldn't we, as a matter of good government, put it back out again, or not do it at all, which would be preferable?
Director Norton.
Well, I think, first of all, Dan, as usual, makes a lot of good points. There's so many rules that came mandates that came at the agencies, and just speaking from a banking regulator perspective, there were a number of issues that took up a lot of time. But I think if you look at sort of bang for the buck, a lot of the things we've done in the banking space were not required by Dodd-Frank, or we already had the authority to do. It was just a question of foresight or will over many years of the agencies to do that. So you have some rules which may or may not be misguided or may not impact the financial system, taking up an enormous amount of time. And then the stuff that needs to get done, there's a dilutive effect. You have a limited number of people working on policy and rulemaking, and you can only have so many comment processes at once. So it's been a pretty disjointed process, and I would say I understand why the Congress passed reform after 2008, but having that many mandates to the agencies, coupling the fact you're putting lots of agencies together, adding on, you have the U.S. Coordinating Council and all these international coordinating councils, it's pretty difficult to make sense of it all.
We've had, as I noted earlier, 63 final rules put out. We've issued 206 no action letters. These are relief from enforcement. Over 24 of those have been as a result of a significant overreach and are indefinite relief, which means it's a rulemaking, right? If you provide indefinite relief from the rule you just passed, even if at the staff level you've changed the rule, that doesn't go through cost-benefit analysis. It doesn't go through notice and comment. It is just out there. And we also have 33 exemptive letters and 36 staff interpretations. So the baseline in which we said, all right, here's the rule set, and then went about changing it significantly. And none of this appears in the code. It's, you have to check our website. And many times the relief we offer is additional conditions on some relief that we had. Now, we're offering relief only because we didn't get the rule right in the first place. We've overreached in the applicants and how many people, like we've captured the entire securitization market, which is outside our jurisdiction. But other than that,
Putting that aside.
so we had to let them back out. So they're probably not so upset with the no action relief. But at the same time, why haven't we gone back to fix that? And why do you have to look in the code for one set of regs and then the relief, if it applies to you or it's expired or whatever additional conditions that are not in the original rule should apply? So this is turned into a kind of a bad nightmare in terms of the regulatory process. And we need to get back to basics, fixing rules where they're broken, making sure we have a transparent process, making sure people can comment. We do the cost-benefit analysis. The panel right before lunch was, I get it. They're struggling with good cost-benefit analysis to get good rules. Our cost-benefit analysis requirement simply says you have to consider the costs and the benefits, not in relationship to one another, but just consider them. That leaves wanting a really good analysis in our rules. We should have quantitative analysis at a minimum. We should have the same standard as the SEC at a minimum, or Circular A4 from OMB at a minimum. I think there are other ways you can bolster that as well to develop a better, robust cost-benefit analysis. It's not going to be perfect, I get it. But we can certainly do more than we've done thus far, and we can certainly include everybody in the debate, even if it's issuing no action letters.
And we're coming up near the end of kind of the panel portion of this, and then we'll be throwing it open for questions. So if people want to start thinking about what they might want to ask the experts we have gathered here, I wanted to ask you about the resource question. This is kind of an issue that's popping up on Capitol Hill again as we're going through the appropriations process, and it's playing out basically the same way it's been playing out ever since Dodd-Frank, has been enacted, which is that the White House puts forward a budget saying we need a significantly expanded budget for the regulators, and then the Democrats want to give it. Republicans say the regulators can get by with less. They don't need nearly that much. And I was just curious, from your perspective, do you feel like you have the resources you need to meet the obligations set to you by Congress, and also what else you want to achieve as a regulator? Is that a position you're in, or is there a need for further resources, as some would say?
But for the SEC, it's a constant refrain from whomever is chair at the time that we always need more resources. I think, quite frankly, it's the whole government. You can always use more resources, and where you've seen failures, look now at the VA. You see some folks saying, "Let's give them more resources." That was the issue. Yeah, right. The government can always use and always wants more resources. So for us at the SEC, the budget is coming up to $1.5 billion a year. I think it's 1.4. When I started at the agency in 2006, it was about 790 million. I mean, that's a pretty sizable increase. Most companies would love to have that delta, from their revenues over a 10-year or 8-year period. It's hard to say as a steward of the agency that you don't want the staff who are working very diligently and, generally speaking, mean very well to have all the resources they can to do their job. But at the same time, I think it's actually more important in a time when the average American has been tightening their belt for 5 years, that the government needs to live within its means too. And we need to focus on efficiency and doing things more efficiently as opposed to just continually adding bodies, adding IT infrastructure and other things around the agency. That's a better focus to me than screaming poor mouth all the time and trying to use as an excuse for any perceived failures in your programs. And the other just specific point that comes to mind too is the SEC getting 100 rulemaking mandates, which I told you in a typical time would mean 10, 20 years worth of work. Does it make sense? Would any corporation that had a fiduciary duty to its shareholders, if it had a temporary project, resource it 100%, hire 5,000 more people to write the rules? Well, then what happens when the rule is done? And you've got the rule writers sitting right there. It doesn't seem to make sense. Maybe some modest increase in resources makes sense, but it also, I think, would have been, would have made the most sense if Congress had given us a realistic series of mandates and, God forbid, they'd be germane to the financial crisis.
Well, as a former appropriator, I've heard and seen it all, right? And the first, like Dan says, the first response is we need more resources. Well, what are you doing with the current resources? How are you applying those? And it's been interesting to watch the development at the CFTC, and our appetite for taxpayer resources is significant, right? We've demanded a lot, and we've asked for a lot. Somehow it corresponds with our budget or with our mission. But when you dig through that, I can't find exactly how the mission and the dollars are going to link up. And I think what we would be better served by doing is to take a strategic analysis of what we need and when. And I've been a big advocate of technology. Congress has provided additional technology for us through a separate statutory line item, and then it continually gets undermined and shifted back towards throwing more people at the problem. We definitely have a technology problem. We are not investing enough. Congress is, we've seen an increase of over 12% over the past 4 years. Technology's only gotten 6%. So internally, we're not being consistent. We're not living up to our goals. And I think if we put forward a strategic plan, which we have not done and which we're statutorily obligated to do, and pick the winners and losers in some of this thing. If we're not going to get it all, and in this budget environment, we're not going to get everything we ask for. That is just not going to happen. In fact, the White House scaled us back in recognition of it because it's taking other resources from other agencies that need it. So they scaled us back, and hopefully that'll focus some attention here. If we start picking and identifying the tools that we need the most to do the job that we have at hand, and recognizing we have a big mission under Dodd-Frank. What are we doing about all the data that's coming in? It's a huge opportunity, but it's not something that we're going to get a bunch of people poring over Excel spreadsheets on. This is a technology-driven market. It should be a technology-driven surveillance program. Automate this. Look for anomalies. Look for nefarious behavior. Build in surveillance tools that computers can do the work and sort all this out, because we do millions of trades a day in the futures markets, and we do 90% more in order information that comes in. There's no way a team of people can just pour over spreadsheets and identify nefarious behavior. We have to automate. We have to go into the 21st century. And I think a strategic plan will help us pick priorities. Right now, everything's a priority, and we've kind of developed a build it and we will come. We've overbuilt in some of our buildings. We've got excess space that is simply not filled in a couple of our offices. And these are been identified by the IG, and those are you don't want IG reports that say, hey, you're not allocating dollars appropriately or cost effectively. So a strategic plan would be my best hope.
So at the FDIC, we're not in the appropriations process. It is, I think, one of the few agencies in government that does expand and shrink, and it's with the banking crisis cycle. So we actually expand our human capital and employee number quite substantially in a crisis, and that does ebb down as things taper. We've also received a lot more responsibility from Congress. So we've always had responsibility for every single depository institution in the country, either as first or second federal regulator. And now we have a responsibility with respect to our Title I role for living wills on every financial institution, 50 billion or greater. So we've got new mandates going forward, and I think for us, the key test is how are we going to use our resources, and I think if you use it unwisely and you don't spend well, then you're going to be subject to appropriate criticism.
And at this point, if anybody's got any questions they'd like to ask commissioners here, we certainly welcome them.
We left them dumbfounded.
Hans Roger AVB. The question is for Commissioner Gallagher. You are absolutely right in so far as the impact of Basel III on the US. The thing is, as Jamie Dimon himself put it in Davos, January 2011, Atlanta, June 2011, to a question to then Chairman Bernanke, and a bit later on, we in America here gave the Europeans the stick to beat us. The Europeans didn't cook it. The US had a seat at the table and could have altered the provisions of Basel III as they related to the banking system in the US. I suppose the question then is, if you don't mind, what were the guiding principles for the US position in the implementation of Basel III?
Well, I think that's going to be more for Director Norton than me, thank goodness.
I'd be interested in your answer, though.
Well, I can tell you my guiding principle when it comes to dealing with Europe. Look at what they do, and either do nothing or the exact opposite. And so, rotely implementing Basel III would not be consistent with that guiding principle. We, the Commission, have an observer status in the Basel debates, but not a voting role. And of course, it's mostly geared towards bank capital issues, which transitively impact our registrants, the broker-dealers eventually. Look, I think that what I haven't discerned, and I'm an outsider looking into both the Basel negotiations, FSB, even unfortunately some IOSCO negotiations where the SEC used to actually be influential, and seeing that, there seems to be this new era of comity amongst regulators where everyone wants to get along and regulate a lot. Regardless of the domestic interests that they're supposed to be representing. And so I've been very critical of things happening in the FSB. I've been critical of things happening at FSOC. And folks who want to dismiss me quickly, of which there are many, want to say I'm just a turf warrior. I want to retain jurisdiction for the SEC. And that's actually not at all true. I just want things to happen efficiently. And where I am, as I said before, one of the stewards of the SEC, I want to be a voice in the policy debate about the markets and the market participants we oversee. Those markets are inherently the non-bank markets, the so-called shadow banking markets, which is meant, I should have had some eerie music in the background to scare you, which are highly regulated, yet still very scary to many. So the SEC, in my view, has not been an active participant in these debates over the years. We've been all too willing to go along to get along, to attend the Basel cocktail parties. And because of that, the capital markets have gotten a bad rap. And a lot of policy has been made around them, and the intent is to make more. You see it every day in every speech that comes out of all these central bankers, and I think it's a real problem. So, maybe there's a need for reform in certain areas, but there certainly is a need for a debate before any reform, and we haven't had it. As to the specifics of Basel III, Jeremiah's.
Yeah, I think a driving principle for me, at least how I think about bank capital regimes, is that there's a big provision of the safety net to these financial institutions, and so we need to protect that, and we should do that for U.S. institutions, And to the extent institutions are coming to the United States and accessing our markets, we should encourage it, treat them fairly. But if they're coming and using the U.S. safety net, they have to use it responsibly. And so I think we should lead in setting responsible capital standards in the United States. And I do think because of the strength that will encourage in our financial system, others will follow. I think there's some evidence of that with the leverage ratio. I was a proponent of having a process to look at the leverage ratio and strengthen it in the U.S. And I now think you're seeing other jurisdictions look to the leverage ratio and look at some of the inadequacies and flaws in the risk weighting system. And so you can lead, I think, from a position of strength, but I would caveat my remarks that I think there's a difference in regulating safety net than disclosure and markets. So.
I don't know if this is, can you hear me? My name's Elaine Middleman, I'm an attorney, and this is probably nothing like what you've been talking about, but I grew up in Indiana, and my family has had long time interest in a community bank, and I can tell you when I go to Indiana, the name Dodd-Frank is not really the name you want to drop. I reminded them that they were both defeated, they were no longer in Congress. But the community banks, I'm sure all of the United States are very concerned with these regulations and the burden on them. And I don't think they're worried about Basel III or anything. I've never heard that mentioned in Indiana. But I think they're glad to have the capitalization and requirements. But I think that what they're more concerned about is being able to lend to the people in their community and have a personal relationship and not have to deal with all this regulation that seems to be caused by something that they had nothing to do with.
Well, maybe I'll take that to start. The data would suggest that community banking is so important to small business development in the United States that we should look at that and be very careful before we disrupt a key engine of our economy. And I think when you look at the enormous flow of rules coming out of Washington and you look at community banks, which are small businesses, we should be asking ourselves, how can they respond to the numerous pages of rules, and what is the objective of these rules, and how will it make the institution better, and how it will make their local market better? I'm not sure that question's being asked enough across the board. I do think that there is a pretty good sensitivity at the FDIC since we supervise most of the community banks in the country, but the rulemaking process has a way of snowballing and having a life of its own. We're losing the perspective of why we have community banks and what they do and how important they are. And if we lose that, we're going to really disrupt growth.
Can I just jump on that too? Obviously, we're not bank regulators at the SEC, but a community bank for us is small business, and we do have a lot of authority with respect to small businesses. And this goes to one of your earlier questions, which is what's the biggest surprises that you encountered coming back as a commissioner. And one of them for me is just, Jeremiah just alluded to the onslaught of regulation. Given the onslaught of regulation, the just complete lack of communication with small business and an understanding, therefore, for the small businesses of the impact of what all of our agencies are doing is shocking to me, stunning. At a time when we have a jobs crisis, a real and continuing jobs crisis, the lack of attention paid to these issues is really kind of scary. And so it's great for folks like you to stand up and remind us every now and again that there are voices not being heard in this debate. And it's good for us, quite frankly, as policymakers to get the hell out of Washington every now and again and meet with folks who actually create enterprise in this country.
Let me just say that was the reason why I came today. I wanted to be able to
Good for you.
speak up for the community banks.
I think that's great.
I think our regulation is too, we're almost paralyzed by if we think about creating a possible loophole, and the snowballing effect of our regulation has led us down this path that we're developing as broad a regulation as possible, over-regulating, in fact, and capturing people that don't bear any relationship to this systemic threat that maybe some Wall Street banks should have us focused on. And so we're constantly under appeal and attack for the overreach in which we've applied our swap dealer regulations and our just the rules in general to end users who are farmers and ranchers and energy producers that are trying to hedge product, build facilities, or buy and sell corn to ship to either U.S. markets or global markets to feed the world. So, you know, we when we run up against this and they come in and they say, you got to give us a break, and then when we said, well, you know, we can't do, you know, it'd be a loophole. Well, that's not who it should apply to, and we should be a little more sensitive. And to really back it up, I'm riding across Iowa next week.
You know, so it's funny. I'm trying to get Pivovar to come with me on a capital formation listening tour through the Rust Belt, because I've done my fair share. I've gone off market for a lot of my trips as a commissioner. I've been to Milwaukee and Pittsburgh and you know, San Diego, which sounds a little more glamorous compared to those two. But when you not only when you go to smaller markets, you get out of the Washington, New York, London, you know, self-fulfilling prophecy tour.
Muscles to that.
Yeah, the self-reassurance dialogue. You know, you encounter folks who actually are involved in the markets you're supposed to be regulating, that are you know, trying to create opportunity and jobs, and also they'll tell you stuff as opposed to the polished message you get from lobbyists and others in Washington. So I think I didn't mean to insult all of you lobbyists out there, but you're pretty polished. So maybe we can go together
Jeremiah's hurt. Bring your bike. We're riding across Iowa next week.
in a pickup truck. That would be
No,
great.
bike.
Oh yeah. So,
Ragbri. I'll be tweeting it.
No thanks.
Hi, my name's Sarah. I'm an intern at Cato Institute. And at the beginning of your talk, you were talking about the core causes of the financial crisis. And I was curious as to what you guys believe the core cause of the financial bubble to begin with was.
So for me, that's easy. I think it was failed federal housing policy, decades worth of it, coupled with loose monetary policy, came together to drive behavior in supposedly private markets that has been translated into Wall Street greed, that caused regulatory failures. You know, at the SEC, elsewhere, the Fed. You know, we all missed stuff, but it was because, you know, as Chuck Prince said, everyone was dancing and no one wanted to turn the music off. Those were the core issues that gave rise to all sorts of other problems that I believe are embedded in Dodd-Frank as the actual causes of the crisis. If you believe it's just Wall Street greed and regulatory failures, well, there you go. You got 2,300 pages to convince you of it. But if it's really loose monetary policy and failed federal housing policy, guess what's happening as we speak?
Nope.
I do think that we got to a place where, to Dan's point, housing was, you know, really courtesy of the government. You had an enormous amount of leverage embedded in the housing sector, and then that leverage made its way into the regulated space. And when you couple those two together, excess leverage supported by the government, I don't think it ends well.
That's right.
So I think that we could have at least an hour on a lot of those issues, but I think the market confusing government leverage for the business model got us to where we were.
Massive problem. Or conflict minerals in the Congo, whichever one you think.
Hi, I'm Justin Merrill with Commonwealth Asset Management Group. What is your gentleman's opinion on marking to market of the money market funds, and do you think they should be covered by deposit insurance?
Why don't you start, Jeremiah?
Well, I'll defer to the mark-to-market, but I want to defer most of this answer to Dan, since he's probably in an open rulemaking process. But I do not support extending the government safety net to the money market business.
Yeah, and I don't want to get too bogged down. Obviously, money funds are a hot and current topic, and we're going to have a rulemaking soon at the commission, and so I don't want to talk too much about the substance, but I completely concur with Jeremiah. There should be no government backstop for money market funds, and there should be no perception that there is. To the extent that marking to market or floating NAV for those products gets us to that place, then it would be a good thing, but we'll see what comes out in the final rule.
And time for one more question.
Sure. Aaron Taylor, I'm with Senator Deb Fisher up on the Hill. Commissioner Gallagher, you mentioned Congressman Garrett's FSOC bill, and others can comment as well. Are there other ideas besides Garrett's bill that you think would be good ideas for FSOC reform?
Well, I just know it's broken, and I don't think I always have all the answers to how to fix it. I'm one who will tell you, I think there needs to be something. I'm not going to say that 2008 actually went swimmingly and it was a lot of fun dealing with other regulators and dealing with the crazy amount of issues that came in real time. I think bad policy decisions were made based on bad information and bad information sharing. The bailout of IG, I think we could sit here and tie it back to a lack of information amongst regulators and certainly a lack of information about derivatives exposures. And you could come up with some simple exposures about that. I think codifying in statute an information sharing regime with some generalized obligations as to each of the constituent member agencies, not individuals, on what their responsibilities are to share and discuss and debate, and potentially maybe some vague notion of what actions would be taken by the respective agency in a group like an FSOC would make a lot of sense. I mean, I was one of the ones in 2008, I was convinced, like I'm sure Jeremiah was, that the Fed was going to become the systemic risk regulator. That was all the talk until the AIG bonuses were released, and boy, did that turn around pretty quickly when Congress got mad about that. To me, it's not any particular skepticism I have of the Fed. They might be best equipped of anyone to do it. Resting it in one spot and getting fully away from the PWG construct I found to be problematic and certainly potentially asking too much of any one body, which I think it would have had we done that with the Fed. So keeping it as a collective group, having it more generalized and focused on information sharing makes sense. And I think, again, Congressman Garrett's bill would do those things. Whether we need the other features or not, I'm not sure.
I wouldn't limit it to just FSOC either. The House Agriculture Committee and subsequently the House as a whole passed reauthorization of the CFTC, which is required, and they passed it on a bipartisan approach. Let's look what isn't working today and fix some of those problems. So you could take the Garrett approach about FSOC. You could take the reauthorization. You could take some of these things. How is OFR working with our respective agencies? What do these relationships look like? How effective are we in sharing data? How effective are we in doing our jobs? And making sure that the system is working, or as it was intended in Dodd-Frank. And then don't be afraid to revisit that stuff. If it's not working,
Right.
Don't make apologies for it. Don't make excuses for it. Fix it. And just because it's going to require some tough votes, we've all been taking tough votes. These are important issues, and you can't say Dodd-Frank was perfect and you shouldn't touch it. That's ridiculous.
I think with FSOC, we have to be very careful about what we expect or think it can achieve. The idea that a government-created committee is going to be able to identify and take prophylactic actions for market instability is a very tough test. And there's a big notion going on in the world right now that macro stability, macro prudential regulation can solve the world's problems. And that is putting an enormous burden on governments of any country to fix problems. And again, not to come back to an argument, but when you're provisioning an enormous amount of government resources to the market, and then expecting you sort of with one hand and your right hand to be able to control how that's used, that is a very tough mission. And I think that's what's happening right now. We're continuing to support the financial system, and then we're asking ourselves to contain the financial system. Yeah. I think we need to set clearer boundaries. I think the perimeter or boundaries are too big in my view, and until we get clarity on that, I think the FSOC and all of our respective agencies are going to be very challenged to serve the American people as well as we could.
Well said.
Great, gentlemen. That was absolutely fantastic, informative.
Well said.
Informative, educational, and I have my new favorite term, bipartisan affliction. I love it.